Hello, this is Mijun from the University of United States Stock Theory. Let's begin today's United States stock news for July 29th. Welcome to Mijun, where we consistently stick to the fundamentals of United States stock investing. Recently, I've been asking you all to leave more comments, and thanks to that, you've been giving me lots of comments and likes every day as a gift. For your information, YouTube's algorithm looks at how much interaction there is between the creator and the subscribers. We usually call this engagement in technical terms. The more interaction there is, the more likely YouTube is to recommend that channel and its videos. So if you care about the Mijun channel, please interact with me more. Hit the like button and leave lots of comments. That way you can have a huge positive impact on the growth of the Mijun channel. Yesterday, a lot of people left comments, and especially people from Malaysia left me comments. Someone with the username Yang Leo commented, "We also moved to Malaysia. It's a great place to live. I'm enjoying your videos. Thank you." And right below that, someone with the username Yumi also said that they are living in Malaysia. They sent a welcoming message saying, "Welcome." Here you can see that Felix Pang says he is a subscriber living in Indonesia, where I used to live for about 8 years. I understand that you used to live here and then moved to the United Kingdom, but now you're coming to Malaysia again. Welcome back to Southeast Asia. I hope your whole family stays healthy and happy. And when I went downstairs, there was more. Here, Raida Pangnem as well. I'm always watching and learning from you. I also live in Kuala Lumpur, Malaysia, so if we ever happen to run into each other, I think I'd be really happy to see you. Welcome to Malaysia, and I hope you move safely. I think there are quite a few subscribers from the United States and China living in Malaysia, besides these people. If you see me on the street, please say hello. I'd really love to greet you. And as far as I know, there are also many Koreans living in Kuala Lumpur, Malaysia. So when I move this time, I personally hope to build friendships with Koreans and make some good friends as well. If you see me, please don't pretend you don't know me. I'd appreciate it if you could tell me that you're a subscriber from the United States or China. And I think there are many people who feel a bit envious about moving to Southeast Asia like this. And some people ask me to share more information about it. Actually, I'm planning to change the character of the Mijun channel a bit in the future. From now on, I'll leave investment topics to the Mijun membership. On the Mijun channel, I'll talk about various stories about life. That will include topics like preparing for retirement, stories about our happiness, and stories about success. I'm planning to broaden the subjects and talk about things like that. Of course, among these, I'll also make content about whether Malaysia is a good place to retire after moving here, and I'll definitely share that information with you. I think it would be good for you to keep that in mind. All right, then let's get started with today's United States stock market news prepared for July 29th. Today, I'll summarize yesterday's United States stock market trends, starting with the S&P 500 map. At first glance, it doesn't look terribly bad, right? You can see some blue areas here and there. But actually, the market yesterday was really not good. There were actually a lot more stocks that fell compared to the number of stocks that went up. So overall, the market went down, but since the tech stocks we liked did well, the way we felt about it wasn't that bad. That's how you can look at it. If you actually look at the movements of various indexes yesterday, only the Nasdaq 100 went up. Microcaps were down 0.02. The S&P 500 was down 0.03. Small caps were down 0.10. The Dow Jones was down 0.15. And mid caps also fell by 0.2%. So everything else went down except for the Nasdaq 100, which went up. That's how you should see it. If you look at the performance of the 11 sectors that make up the S&P 500, yesterday it was energy, tech stocks, and consumer discretionary. This is the sector that includes Tesla and Amazon. So these three sectors recorded gains of 0.5% or more, while the rest of the sectors were all in the red. Now, the best performing sector yesterday was energy. Those of you who watched the broadcast yesterday already know the reason. Yesterday, I told you the news that Trump reached a tariff agreement with the European Union at a relatively reasonable percentage of 15%. And one of the most important points here was that the European Union agreed to purchase $75 billion worth of American energy. There was such a clause. Therefore, it seems we can summarize that yesterday, all the energy-related stocks cheered together. Next, we'll look at the market breadth of the S&P 500. Since there were so many stocks that fell yesterday, the market breadth has narrowed significantly. Yesterday, 72.9% of stocks were trading above their 51-day moving average, but this ratio dropped sharply to 66.9%. Also, even the stocks with a good long-term trend fell from 63% to 60% yesterday. A narrowing market breadth like this isn't a good sign. Right now, you can see that stock prices are mainly performing well in tech stocks. Next, let's take a look at the fear index. It's at 14.73, which is really low. So if it keeps staying this low, you could actually interpret it negatively, saying the fear index is too low. The reason is when the fear index is low, it means investors aren't worried. And when people aren't worried, even a small piece of bad news can catch them off guard and surprise them. That situation could lead to a sudden stock market crash. For now, though, people are in a situation where there's no fear at all. So even though the fear and greed index is very high, the market itself is in a very ideal state with no fear. The fear and greed index is at 73, so there's a lot of greed right now. Of course, we've moved away from extreme greed, but even so, the market is still overflowing with greed. Right now, everyone is watching each other. Who's going to sell first? People are reluctant to sell stocks that continue to rise in value after purchase, contributing to the ongoing upward trend in the market. But if some kind of trigger appears, if something really bad happens, then there's a possibility that a lot of people will rush to sell all at once. That's something we can predict. The market score is also 86. That means a lot of stocks are showing a good trend. Many people have profited from stock investments. With so many people making money this way, as I mentioned earlier, if bad news occurs, a technical correction is always possible. That's how you should see it. Next is the performance of Mijuan's top picks. Now, Mijuan's top picks were in the top 20 until just yesterday, but one stock has disappeared. So, in a moment, I'll tell you in detail which stock from Mijuan's top picks was eliminated and talk more about this stock. Credo Technology was the top performing stock among Mijuan's picks yesterday. The stock price rose an additional 6.65%, and with that, Credo has shown a very strong upward trend, increasing by 12.75% in just 1 week. Secondly, AMD rose by 4.32%. Third, Talenergy went up by 3.51%, Tesla by 3.02%, Trade Desk by 2.69%, and B2 rose by 2.02%. Vistra went up by 1.91%, Nvidia by 1.87%, Celestica by 1.85%, Broadcom by 1.42%, Meta by 0.69%, Amazon by 0.58%, and Bitcoin rose by 0.51%, reaching 118,650. Now, the remaining 6 stocks fell. Alphabet dropped slightly by 0.31%. MicroStrategy was down by 0.51%, Palantir by 0.58%, First Solar by 0.94%, TSMC by 1.16%, and Coinbase dropped the most, falling by 3.11%. Before I introduce the stocks that have been dropped from the Mijuan topic starting today, I think I should talk about some other stocks first. Yesterday on the broadcast, I introduced the highlights of the United States stock market for this week. While talking about that, well, that was yesterday. On Monday, the only stock we needed to pay attention to was Celestica. Yesterday, Celestica announced its earnings results. If you look at Celestica's stock price, yesterday during the session, it went up by 1.85%. And after announcing its earnings results, the futures index is now showing a sharp upward trend of as much as 12.36%. So, first of all, I'd like to start by explaining how Celestica's earnings results were. I've organized it neatly here. Let's start by looking at the revenue and net profit. The revenue was $2.89 billion, which is a 21% increase compared to the same period last year. Well, a 21% growth rate, isn't that impressive these days?
Because,
In the case of NVIDIA, it goes up by 60%, so you might think 21% is just whatever. If you look here, the company's own guidance was between $2.575 billion and $2.725 billion. So it's a much higher figure than the guidance they provided themselves, about 10% higher than their guidance. The adjusted earnings per share were even better. It recorded $1.39, while the same period last year was $0.90, so net profit surged by 54%. And again, the guidance was only between $1.17 and $1.27. The $1.39 result was truly impressive, surpassing expectations. The adjusted operating margin was 7.4%. Well, 7.4% isn't a particularly high operating margin because it's a manufacturing business. But this figure actually marks the highest in the company's history, and it shows that profitability is steadily improving. That's how you should see it. Now, next are the results by business segment and the main activities. Celestica's business is largely divided into two parts. The first is Connectivity and Cloud Solutions, and the second is Advanced Technology Solutions. Advanced Technology Solutions grew by 7% compared to last year, so you can say it performed fairly well. The important part is here, the Connectivity and Cloud Solutions section. Thanks to artificial intelligence demand, it recorded sales of $2.07 billion, a 28% increase compared to last year. And within the Connectivity and Cloud Solutions section, Hardware Platform Solutions sales reached an impressive $1.2 billion, showing an 82% growth rate compared to last year. This part is positive because the remaining Hardware Platform Solutions here refer to various solutions that are directly related to artificial intelligence. For example, what Celestica makes are network switches that connect servers to each other. They make a lot of these switches, and they also make servers themselves, as well as storage devices. Therefore, a lot of various hardware related to artificial intelligence has been sold. It grew by 82%, so we can interpret this as a positive sign. Celestica has repurchased 600,000 of its own shares for $40 million, demonstrating the company's confidence and strong cash flow. This share buyback is a positive sign for the company's financial health. Also, their guidance was good. They raised their full year 2025 performance guidance. First of all, their annual revenue outlook was previously $10.85 billion, but now they've raised it to about $11.55 billion. And for the annual adjusted earnings per share, the earnings per share outlook was originally expected to be around $5, but they've raised it to $5.50. Lastly, they had previously projected free cash flow at $350 million. Now, looking at it, it seems like even $400 million is possible, showing a very good trend of raising their outlook. And they've also raised their guidance for the upcoming third quarter, projecting revenue from $2.875 billion to $3.125 billion. They announced that the adjusted earnings per share could be between $1.37 and $1.53. So in conclusion, Celestica, in the second quarter of 2025, they reported very positive results overall, including revenue growth, improved profit margins, and upwardly revised guidance. Both revenue and earnings per share showed growth that exceeded expectations. In particular, the fact that the adjusted operating margin reached an all-time high shows that management efficiency is steadily improving, and we can predict that they are selling their products at very high prices, and that demand is so strong they can't keep up with it. Now, the Connectivity and Cloud Solutions segment grew by as much as 28%. Especially the sales in the Hardware Platform Solutions or Hardware Platform Solutions division surged by 82%, which once again confirms that it is indeed a beneficiary of artificial intelligence. Now, they also raised their guidance and bought back their own shares. Therefore, we could say that the management has tremendous confidence in their future performance and cash flow outlook. So as a result, Celestica's stock price has surged more than 10% after the earnings announcement. Let's take another look. It's creating a good trend, rising by 12.36%. Now, as you can see here, Celestica's year-to-date return is 87.83%, and its one-year return is a whopping 229%. Therefore, there's no need to lower your evaluation of a stock just because its price has gone up a lot. The fact that the stock price has gone up can actually be evidence that the fundamentals are improving significantly. In times like this, it creates an opportunity for the stock price to rise again. Therefore, I was able to confirm once again that how the stock price will rise in the future has nothing to do with whether it went up a lot or dropped a lot in the past. At the beginning of the broadcast, I gave a hint that I reduced my mid-yuan top picks from 20 stocks to 19, dropping one stock. The stock that was excluded from the mid-yuan top picks this time is Uber. Personally, Uber is one of the companies I feel very grateful for. Because back in mid-2023, I went to Korea and held an offline meeting, an offline lecture. At that time, I selected 10 mid-yuan top picks and revealed them to you, and then I chose the 5 stocks that looked the best among those 10 and announced the mid-yuan top 5 to you. If you look at the previous videos, you'll see it there. But among those 5 stocks, there was Nvidia, Palantir, and also Supermicro Computer. There were various stocks, and one of them was Uber. At that time, Uber's stock price was less than $20, around $15 or $16, something like that. In the end, it became a 10-bagger. So personally, Uber is a stock I'm really grateful for, but this time I've decided to let it go. The reason is that Waymo is letting go of Uber. Let's take a look at what this means. Alphabet's subsidiary Waymo is planning to launch a robotaxi service in Dallas next year. But the important thing is, who are they partnering with? That's the most crucial part. They're doing this through a partnership with Avis Budget Group. This means that autonomous vehicle companies are making efforts to diversify beyond their relationship with Uber in order to expand across the United States. Waymo announced for the first time ever that Avis will serve as the vehicle partner for its robotaxi fleet in Dallas. Youngson said in a statement on Tuesday that customers will be able to hail vehicles using the Waymo app. Avis announced that it will provide vehicle management services, including infrastructure, vehicle preparation, maintenance, and overall garage operations. According to the statement, this partnership is based on long-term cooperation, so it's not a one-time thing, and it is expected to expand to other cities in the future. So for Uber, this is really depressing news. Now, what about Avis? By entering the robot, taxi, and vehicle management markets, they have become competitors to Uber and Lyft. That's one perspective. Now, about this announcement, they're emphasizing that Waymo and Uber are both partners and competitors. That's how you can see it. To sum it up, currently, there are 5 cities where you can use Waymo vehicles, and among them in Phoenix, San Francisco, and Los Angeles, they provide the service through their own app, meaning the app developed by Waymo. In Phoenix, Austin, and Atlanta, they have a partnership with Uber, so they serve customers through the Uber app. That's how you can see it. Now then, what does this article mean that makes me say I'm leaving Uber for Waymo? I think I should talk about that. This news could be a significant threat to Uber's future, and in the long run, it could be the starting point of an important change that could weaken Uber's position. That's how I'm interpreting it. Now, let me tell you why. Uber used to have a strong moat. What this means is, first, the driver network. There was no other app connected to as many drivers as Uber, and through this, they built a user network. Uber is the company that has these 2 strengths. This is why the company's stock price has soared in recent years. It's a valid perspective. Now, Waymo is working to secure customers through its own app by directly providing robotaxi technology, which is the product, and vehicle operation services, offering both products and services. That's what it means. They're building a new transportation ecosystem independently without Uber. It's that kind of strategy. If customers start to feel satisfied with the experience of calling a robot taxi using the Waymo app, in fact, they no longer need to open the Uber app. And this can be seen as a direct threat that undermines Uber's most powerful asset, its user network. But in my opinion, there's an even bigger problem. I think the bigger issue is this, The fact that Waymo chose the rental car company Avis as its vehicle operation partner this time, I think this has a very significant meaning. The ride-sharing company Uber and the rental car company Avis have one fundamental structural difference. So what is that? It's people. Uber has about 7.8 million drivers, and those drivers have families as well. But Avis only owns cars that can be immediately converted into self-driving taxis. So for Avis, not having people is actually an advantage. So what this means is that for autonomous driving technology companies like Waymo, when expanding their business, it's much easier and more efficient to form partnerships with rental car companies like Avis rather than with Uber. That's what we can infer. Because in the case of Uber, they have to keep the fare for autonomous taxis at a level similar to the existing service price operated by human drivers. If they don't do that, the drivers will take action. And if Uber sets the price of autonomous taxis to match the price of ride-sharing services operated by human drivers, there's no way they can survive the competition with Waymo and Tesla. But on the other hand, if they offer the service at a competitive price, there will be no drivers or vehicles left for Uber, and their economic advantage will completely disappear. That's the logical conclusion we can draw. So you can see that Uber is currently stuck in a very difficult dilemma that is hard to solve. Eventually, when robot taxis become widespread, it's clear that taxi fares will be much cheaper than they are now. That's because there are no people involved, and eventually Uber will be forced to reconsider their entire revenue model. This is the future as I see it. For example, there's a way to integrate all mobility services, including Waymo, Tesla, and others, into their own platform, turning it into a mobility integration app where users can choose the optimal option. They will have to evolve in this way, but the problem is that it's very uncertain whether evolving like this will actually succeed. Uber stock has been a star performer, delivering over 50% returns just in 2025. During the same period, Tesla plunged nearly 20%, so Uber was a really good stock for us. However, at this point, it seems to be the riskiest among the top picks in the United States market. So there's really no need to make money specifically with Uber stock. If there are a lot of risks, I personally think it's necessary to move this capital to a safer and more reliable stock. Additionally, Uber stock currently has the weakest momentum among the top United States picks. As shown, it's currently rated neutral by Mutual, while most other United States top picks are rated buy. But in the case of Uber right now, 9 indicators are recommending a sell, 9 are neutral, and only 8 are recommending a buy. That's how you should see it. The relative strength index has also dropped below 50. What does that mean? So Uber is a stock that doesn't even reach the middle, meaning its momentum is actually lower than the market average. That's how you should see it. Now, the 1-year stock chart doesn't look that good either, because right now, it's testing the $88.8 support line. If it successfully rebounds from the $88.8 support line, that means the stock price could go back above the 21-day moving average. That's how you should see it. Right now, it has broken below the 21-day moving average. That's a very bad sign. Now, if the strong $88.8 support line breaks, that means 2 patterns will be confirmed. The first is a double top, which means it drops twice from the same high point. If you look here, you can see a head and shoulders pattern. The head and shoulders pattern usually appears before a decline. So right now, Uber stock is facing 2 negative factors. The first is that the fundamental story is changing because it's being abandoned by Waymo. The second is that the momentum is declining. So for these reasons, Uber stock was removed from Mizuho's top picks this time. I'll wrap it up like this. The last content prepared for today is the Mizuho podcast, and the main topic of today's podcast is Meta, which is one of my favorite stocks. Meta Platforms is set to announce its earnings tomorrow, Wednesday, July 30th. Now, expectations are very high, so I put together a podcast discussing what kind of earnings Meta Platforms will announce and how its stock price might move. That's all for today's broadcast. I sincerely thank everyone who stayed with us until the end. I look forward to your likes and many comments today as well. Let's all keep going until the day we can retire through investing in United States stocks. Have a happy day, and thank you. We spent the weekend saying goodbye to our friends. I feel a bit sad, but I also think about how happy I'll be to see them again later. My feelings are complicated.
Hello, that's right. I did quite a lot of moving preparations this weekend, and since I have to keep packing boxes today, I'll try to get things done quickly. It's the season when big tech companies are announcing their earnings, and among them, Meta is this week. On July 30th, Meta will announce its quarterly earnings. The stock price is slowly creeping back up to the all-time high it reached last February, so expectations are high. I feel both excited and a bit worried at this point. So today, based on some analysis reports, let's take a deep dive into the key points of this earnings announcement.
This time, the possibility of increased capital expenditure is especially important. And we should also focus on the impact of the artificial intelligence model Llama and potential risk factors. We need to look for clues as to whether Meta can continue this upward trend.
All right, then shall we start by talking about CapEx, capital expenditures, which is what the market is paying the most attention to. Analysts have their prior 2025 CapEx estimates between $64 and $72 billion.
That guidance.
They're warning that it could exceed that. Some even predict it could easily surpass $72 billion. What's the reason for that?
The main issue is still the lack of computing resources. This means that training and applying artificial intelligence models, particularly Llama, to real services requires immense computing power, and the demand for this is increasing excessively.
I see. That's actually the core business that makes money. Concerns exist that resources required for advertising or recommendation algorithms may become inadequate. In fact, during the first quarter earnings announcement, the chief financial officer admitted that it's a bit difficult to meet the demand for computing resources, artificial intelligence.
It really shows how fierce the economy is. It's not enough to just look at the capex figures, we need to examine the details. How can we figure out whether this is truly an increase in investment to improve computing performance, or if it's just higher costs due to external factors like tariffs?
That's a very accurate point. The chief financial officer's Q1 remarks mentioned supply chain issues and trade negotiation uncertainties. If higher tariffs substantially increase costs, the real impact of enhancing artificial intelligence abilities may not meet expectations, leading to discussions about efficiency.
That makes sense, but there are counter-arguments too, right? In the case of Google, when they recently announced an increase in capital expenditures, there was hardly any mention of tariffs. Yes, that's right. And even if the Trump administration's tariffs are reinstated, considering America's artificial intelligence leadership, the actual tariff rate won't be that high. Some analyses say it will be less than 10%, maybe mid-single digits.
Some also view tariffs as merely a negotiation tactic.
That's right. In the end, it will be really important to check the quality of the capex increase in this earnings report.
That's correct. Now, next is the impact of the artificial intelligence model Llama. But if we look at the positive side first, as this Llama-based algorithm improved, the time spent on Facebook and Instagram increased by a single-digit mid-range percentage. This can directly increase ad exposure or improve conversion rates, thus helping with advertising revenue.
Interestingly, in Q1, monthly active users exceeded 350 million, and usage time jumped by up to 35%.
Yes, that's right. It's incredible. And on top of that,
the Llama algorithm test contributed an additional 4% as well. There's also this kind of analysis. Do you think this could also help prevent users from leaving because of ads?
There's definitely a possibility. But you have to remember that Llama is a bit of a double-edged sword. It can make the platform more attractive, but as I mentioned earlier, it also consumes a huge amount of computing resources. How will they allocate resources between their core advertising business and this? That issue is bound to keep following them.
I see. The third point is Reality Labs. This part is really something. Over the past year, revenue accounted for only 1 or 2% of the total, but losses exceeded a whopping $18 billion.
Yes, that's truly an astronomical figure.
Is there any chance for a turnaround or something like that?
There have been some recent developments. There's a military technology company called Enduril. There was news that they formed a partnership with this company and secured a Pentagon contract. They also started an offline store strategy, opening their first store in California where people can experience products like the Metacast headset or Navane ARS in person. So it's worth paying attention to whether these efforts can help stop the recent decline in sales and lead to a rebound. Even though it's a small portion, if there are any signs of improvement here, the market could respond positively. Well,
Opening one offline store doesn't seem likely to make a big change to the annual loss structure of over $18 billion, so we'll have to wait and see if it can be more than just symbolic. Now, let's go over some of the risk factors for the last part.
The most immediate risk would be the exemption from the minimum threshold, which was abolished last May, known as de minimis in English.
The abolition of de minimis, yes.
What this means is that small value goods used to be cleared without tariffs, but now that's been blocked. Especially for low-cost e-commerce companies based in Asia, like those in China, their advertising spending in the United States is already decreasing. The chief financial officer confirmed this.
Oh, so it's already having an impact, yes.
So it's still a bit uncertain how much this impact will be reflected in this quarter's results and also in the annual outlook, the results.
I'm sure this will definitely come up as a question in the Q&A after the earnings announcement.
That's right, it's highly likely to come up. And the issue of increasing capex that we've been talking about, if it's really due to rising costs, then this could also be a risk factor in terms of efficiency.
Yes, that's right. So overall, what do analysts think?
Overall, analysts are maintaining a strong buy opinion on Meta. They expect both this quarter's revenue and earnings per share to meet or even slightly exceed market expectations.
That's positive.
Yes, the improvement in advertising based on Llama is expected to more than offset the impact of the minimum allowable standard exemption and abolition I mentioned earlier. And there's also an expectation that Reality Labs will see some improvement as well.
But still, I think the biggest variable is capex. Right, that's correct. There's still a possibility it could be revised upward. That's definitely a point we need to keep in mind. The analyst expects the stock price to hit an all-time high after the earnings announcement.
Yes, today we went over the key points to watch ahead of Meta's second quarter earnings announcement. There are so many variables to consider, like capex, Llama, Reality Labs, and even risk factors.
Yes, there really are a lot. Lastly, I'd like to ask you all this question. Meta is making huge investments in artificial intelligence, which is such an incredible driving force for the future. At the same time, do you think Meta can continue to maintain this delicate balance without hurting the profitability of its main source of revenue, the advertising business? How do you see this balance point? I think this process will be the most important factor in determining the future direction of Meta's stock price. I hope today's analysis has been somewhat helpful to your decision making. Today as well.
Thank you for your company. Enjoy your day.
The start of a small dream is important. Let's plant a hopeful future together. Growing little by little every day. Do you feel excitement in your heart? Let go of your greed. It won't be any different this time either. The result is just a continuation of the process. Even if dark adjustments come, I'm not afraid. Holding Miju's hand, I'll move forward and become the light of an unseen tomorrow. Happy investing, supporting each other's dreams. Let's walk together down this beautiful downhill path. Happy investing, all of us together, boldly and noisily until the day we decline.
Thank you.